Good morning, guys. So we have about 3 minutes. So we'll just wait for those 3 minutes before we start the class. Okay. Right, guys. Good morning. So, any doubts from corporate actions class before we continue on to stock borrow lending? Just a heads up, your asset management class will be covered next weekend. Okay. So, any questions or doubts from corporate actions? Okay. So, if there's no doubts, we'll start today's class. Today's class is going to be something called as securities borrow and lending, or even it's called as stock borrow lending. So, any clue as to what is stock borrow lending? Anyone? What could be stock borrow lending? For short, it's also called as SBL. Guys, didn't have breakfast today. Am I not audible or your audio is not working? You can let me know on chat. Okay, so Piyush says he doesn't know what is stock borrow lending. Okay, so as the word says, or the sentence, stock borrow lending, what is borrow and what is lending?
Lending of securities by one party to another.
Exactly. It's nothing but lending of securities from one party to another party, or borrowing of a securities from one party to another party. Is the screen visible to everyone?
Yes, ma'am.
Okay. So,
Yes, ma'am.
stock borrow lending is also referred to as securities borrow and lending. So, what happens is you have lenders, you have borrowers. Lenders who have securities, and we'll get to what type of securities are loaned a little later in class. And then you have borrowers who want to borrow the securities, okay, for certain reasons, which again we'll discuss a little later in class. As a lender loans securities out to the borrowers, in return the borrowers have to give something called as collateral. Why is this? Why does a borrower have to give collateral to the lender?
Maybe for
Ma'am,
some
for the
kind of
purpose of
security.
security.
For a default.
For some
Okay.
purpose of safety and
For the
security.
purpose of security.
Yes,
There is no
correct.
default.
Correct. So, in case if the borrower defaults on returning the securities, the lender is covered with that collateral. Okay. So, you have securities that are loaned to the borrowers, and the securities can be any type of shares or any type of bonds. And the borrower gives collateral. Now, collateral can be either in cash form or it can be in non cash form. So, when you say non cash form, it's usually another type of security. And predominantly in the stock borrow lending market, if it's non cash collateral, it's usually government bonds that are given as collateral. So, can you name some government bonds for me?
Treasury bills.
Treasury bills is a money market instrument. So, I wouldn't.
T-bills,
No, T bills
um,
again is a money.
bonds,
Buns, yes. Thank you, Anupam. Buns, what else?
Guilds also.
Gills, correct. What else?
SGB.
Sorry?
SGB में sovereign gold bonds.
Yes, sovereign gold bonds. So any type of bonds that are issued by the governments, okay, and predominantly it will be your treasury bonds in the US market or US government issued. You have gilts which are your UK government issued. Then you have bonds which are German government issued. Then you have something called as these oaths and BTA and S, which are French government bonds. Okay. Now, this securities are loaned indefinitely, or do you think there's a timeline in which the borrower has to return it?
And timeline is there.
Yes, correct. So at the end of the contract or end of the time for the borrower to return the securities back to the lender, what would happen then is the borrower returns equivalent securities and the lender returns equivalent collateral. The reason why equivalent securities is mentioned is because most likely the borrower has used the securities that have borrowed in the first time for some reason, which again will be discussed a little later on in the class. Okay. So borrower at the end of the contract must return equivalent securities. Okay. Either on open or demand, meaning whenever the lender recalls the securities or at a future fixed date, which is called as term. So I'll put it in example. So let's say the lender loans securities to the borrower, okay, and tells the borrower the return date has to be, let's say, 15th of November, for which, let's say, they entered the contract today. So lender gives the securities, borrower gives the collateral. Now the lender says the end date of the contract will be 15th of November. Okay. If the contract is an open contract, any time between today to the 15th of November, the lender can recall the securities back. That is called as an open contract or a on demand contract. Is that clear to everyone?
Yes, ma'am.
The other end of it is, now the lender has said, okay, 15th November is the fixed date you have to return the securities to me. Before that, I will not recall. So that is called as a term contract. Now, have you understood the difference between open and term, or demand and term? Yeah. So similarly, the lender has to return the equivalent collateral that the borrower has given the lender. Is everyone clear till here? Okay.
Ma'am, that open contract, can you repeat that again? Open contract?
Sure. Open contract is, let's say, if I'm the lender, you're the borrower, Saujanya. The end date of the contract is 15th November. So that means on 15th November, you will have to return the securities that you have borrowed, right? Now, if it's an open contract, I might decide as a lender to recall those securities that you have borrowed before the 15th of November. So that's called as an open contract or on demand contract.
Okay.
Okay. The term equivalent securities or collateral refers to identical type, nominal value, description, and amount. Okay. The reason why equivalent securities is because the original securities are likely to be used by the borrower. Is everyone clear with the basics of what is stock borrow lending now?
Yes, ma'am. I just have a small query about equivalent securities. Could you clear that up? Like, what is meant by equivalent securities?
So let's say, Anupam, you've borrowed, let's say, treasury bonds from me, for which you gave me cash as collateral. Okay.
Okay.
Let's say you borrowed UK government bonds. All right. Now, at the end of the contract, you have to return those same UK government bonds or similar UK government bonds, or maybe even a US government bond. So that is meant by
Okay, got it.
identical type and nominal. Obviously, if you borrowed, let's say, 100,000 bonds, you have to return 100,000 bonds to me.
Okay, got it. So the net cash value of those bonds has to be same. It might not be UK bonds, but it can be something else.
Yes, provided that the
Okay.
borrower has, like, he has used the original securities that he's borrowed for some other purpose, which we'll get on to later on in the class. If he doesn't have those type, he can give something similar back to the lender, but it has to be of equivalent value and type.
Got it.
Okay,
Thank you.
no problem. So I'm just going to scroll up a bit for you guys to start writing. Let me know when I need to scroll down.
Ma'am, can you please scroll down?
Hello.
Yes, Divya.
Ma'am, good morning. I just had a doubt that, is a repurchase agreement is security borrow lending? I'm just, in that doubt.
Sorry, could you repeat that? Are you talking about
That,
repo agreements?
yes, ma'am.
They are sort of similar, but they are not. And again, little later on in class, we'll know the difference between a stock borrow lending and a repo agreement.
Okay.
Okay,
Okay, ma'am. Fine. Thank you.
no problem. Done? Okay. So the next thing we're going to discuss is we talked about the basics now. What is stock borrow lending? We said that lenders who have securities loan out their stocks to the borrowers. The borrowers give collateral in return, and the collateral is to protect the lender if the borrower defaults. But what else does the lender get in return? So the lender gets something called as lender's fee, or in other words, it's also referred to as rental fee or sec lending fee, or it's also called as stock loan fee. Okay. So the one of the main reasons why your lenders would loan out securities is they would get something called as a rental fee in return. Okay. Now the rental fee, how much does the lender charge in terms of rental fee is dependent one on what type of collateral the borrower gives, which we'll discuss a little later. Okay. Also, factors that would include when the lender decides to charge the fee as to what all he'll take into account when he quotes the lender's fee to the borrower. So first he'll look at what are the types of security or he has loaned to the borrower. So you have something called as scarce securities. Can you kind of guess the word scarce, or do you know the meaning of the word scarce?
Oh, rare.
Rare, exactly. So securities that are rare, or in other words, like mentioned here in the notes, scarcity factor means low supply but very high demand on the securities. Okay. Can you think of a security that would be scarce in the market? Can you give me an example? I'll give you a clue. It's from a company that is owned by, I think now he's the third richest guy in the world, or in terms of the financial industry. Another clue is very old. Gasoline shortage in 1970s. How does that tie up to scarcity factor in terms of securities, Preetham? We're talking about securities, like your stocks, bonds, all of that.
Tesla?
Tesla is a good example. What about Berkshire
Or
Hathaway?
SpaceX or something?
Warren Buffett, yes, Berkshire Hathaway. In the market, the outstanding number of shares of Berkshire Hathaway is, I think, under 700,000, if I'm not mistaken. And each share, how much is it worth now? Since you guys are at home and you have access to Google, how much is one Berkshire Hathaway worth? How much is it? One Berkshire Hathaway share.
1,25,000 dollars.
Sorry?
1,25,000 US dollars.
125,000 US dollars. Are you sure? Yeah, Chetan and all got it right. Anand got it right. It's 313,885 US dollars. That's a lot of money, right? For one share. Yes or no? Also, owing to the fact that there is only 700,000 shares or less than that available in the market, we classify it as a scarce security. Okay? So, lender, when he is loaning, the rental fee would depend on the types of securities that he is loaned or that is borrowed from the borrower. Okay. Also, it will depend on the credit rating of the borrower. So, it is inversely proportional to the fee. What does that mean? If the borrower's credit rating is low, will the lending fee be or rental fee be high or low?
It'll be high.
Exactly. And vice versa. If the borrower's credit rating is high, then the rental fee that will be charged will be a little lower. Then it is dependent again on the collateral posted by the borrower. So, if the collateral value is high, then the fee is low. That means, to put it in example, let's say if the lender loans securities that is worth 1 million and the borrower gave him collateral that is worth maybe, let's say, 2 million, which is way higher than the amount of securities that is borrowed, right? So at that point of time, maybe the lender would charge a lower rental fee. Is that clear? Okay. It also depends whether the contract is an open contract or a fixed contract. Now, if the lender promises not to recall the securities before the end date, then he might charge a higher rental fee. If he's saying, okay, I cannot guarantee, I might recall it before the end date, then he would charge a lower rental fee. Is that clear? Okay. And also it depends on the market conditions, how the market is doing right now. So, lender, one of his gains for loaning securities is the lending fee. Okay. Write this down before we continue.
Ma'am, so quick question. So this concept of lending and borrowing, right? I'm just trying to understand, what's the benefits of this. So basically, there is a share, and loan it to someone. So the person B gets all the, whatever dividends or whatever is like associated with that security for that fixed period of time. And then once I'll take back that security, then the borrower stops getting that amount, and I will get back my dividend. And right, and the thing is, I'm not saying what is the benefit of this process. I'm just trying to
So
understand.
right now we're looking at it from the lender's perspective. One benefit for him is he's getting rental fee. Okay.
Don't you think that would be equivalent to getting a dividend on the security? I mean, on whatever, like on
No,
the share or.
no. Little later on in class, I'll show you how the rental fee is calculated.
Okay,
Okay.
thank you.
No problem. Okay. So let's talk about when cash collateral is posted and when non-cash collateral is posted by the borrower, the rental fee the lender charges the borrower. So when non-cash collateral, when I say non-cash collateral, it means the borrower gives some type of security as collateral. In that case, the rental, it's just the rental fee that is charged by the lender. Okay. The rental fee is then denoted in terms of basis points. So you know what is basis points, right? Yes or no? Yes, right? Basis point is 1/100th of a percentage. So 1 second, right? Okay, so where were we? Sorry about that. So basis rental fee is denoted in basis points. So we have an example here. If the securities loaned is worth 10 million and the rental fee that is charged is 50 BPS, then what would be the rental fee that the lender would get at the end of the contract? Okay, is this clear, folks? Yeah. Now, if cash collateral is posted by the borrower, meaning instead of giving types of securities or any type of securities as collateral, the borrower gives cash. What are the major types of currencies that can be posted as cash collateral? USD, yes. What else? Euro, yes. And one more.
GBP.
GBP, exactly. These are the three main.
GBP.
Yes, these are the three main currencies in stock borrow lending that can be posted as collateral or used as collateral. Okay. Even if it is cash collateral, the lender still charges something called as a rental fee to the borrower. Okay. Keep that in mind. Even if cash is given as collateral to the borrower, the lender, sorry, the lender still charges something called as a rental fee. But now here's the thing. Because the borrower has given cash to the lender as collateral, the lender is obligated to invest that cash in the market. Okay? As per regulations in the stock borrow lending market, the regulators have said if lenders receive cash from the borrower as collateral, the lender has to reinvest that cash in the market. Okay? And if they reinvest that cash in the market, they will get some returns, correct? Yeah. Now, part of that return has to be rebated back to the borrower as per regulations. So that is referred to as rebate interest. Okay. So, as per regulation, if a borrower posts cash collateral, then the lender is obliged or obligated to invest the cash in the market, and the interest that is earned on this cash is rebated back to the borrower, which is called as rebate interest. Okay. So, in practice, what the lender actually does is, okay, I've loaned you securities, you've given me cash. I'm going to charge you a rental fee. Now, what the lender does is he takes that cash, he reinvests that cash in the market, and he's predicting or he's getting a 100 BPS investment rate back. Out of that, he's going to rebate, let's say, 60 BPS to the borrower. So, what he would do, in fact, is just deduct this from the reinvestment rate, and remaining becomes his rental fee. Is everyone clear with this, or you want me to explain it more? Okay. So, whenever cash is posted by the borrower, the lender is obligated to invest it in the market as per regulation, and a part of that has to be rebated back to the borrower. Is this clear to everyone? Okay. So, write this down. Is this visible? Let me know when you want me to scroll down.
Ma'am, another thing, how did we get the reinvestment rate of 100 BPS?
Oh, I just took a random number. So what would generally happen, Anupam, is when the lender receives cash as collateral, he'll already plan, like, let's say he's reinvesting it in the fixed deposits. So when you do a fixed deposit, you already know what is your return, right? The interest.
Okay. Okay.
Okay.
So the reinvestment rate in BPS will already be known to the lender, and he'll just tell that to the borrower.
Yes.
Accordingly, the calculations will be done. Okay.
Yes. Okay, and just a disclaimer, the reinvestment rate will always be higher than the rebate interest. Okay, that means the reinvestment rate will always be higher than the rebate interest is because they want, obviously would want to pay little less back to the borrower, but they would look to invest in such a market that the reinvestment rate would be higher than the rebate interest that they have promised the borrower in case if cash is posted as collateral. Yes, Anupam. So what would happen now is instead of rebating or paying the rebate interest to the borrower, they would just deduct it from the reinvestment rate. Okay, and the remaining would be the rental fee that they would charge the borrower instead of paying him the rebate interest and then charging him the rental fees again. Can I continue? Okay. So the next thing we're going to talk about the types of securities that are loaned. Okay, so one obvious one is equities, that means any type of shares. What else can be loaned, do you think? The types of securities that are loaned. So this is what the lender has and the borrower wants to borrow. So types of securities that he can borrow or types of securities the lenders can loan. So one is equities. So anything else that comes to mind, guys? Not derivatives, Anupam, because the thing with derivatives is you don't need to hold the underlying stock, right? Sometimes derivatives is primarily used for speculating, hedging, and arbitrage. Okay, bonds, yes. Any other securities you can think of? Okay, so types of securities that are usually loaned are equities. Saujanya, FX is currencies. In the title itself, it says stock borrow lending, right? Okay, so equities, bonds such as your government bond, corporate bonds, and something called as supranational bonds. Have you heard of this term supranational? If you haven't, what supranational means is supranational entities, which is actually made of two or more central governments with the purpose of promoting economic development of member union countries. For example, like the UN, IMF, etc. Okay, can you name some other supranational entities? Yes, European Union,
Asian Development
ECOFIN.
Bank, National
Yeah. So
Asian Development Bank.
yeah, so these are some of your this thing, what do you say, supranational entities, and if they issue bonds, they're called as supranational bonds. Okay. So other types of securities that can be loaned is your mortgage backed securities, your asset backed securities. Okay, what are and then hybrid securities like your convertibles. What are convertibles?
Debt securities which can be converted to equities.
Exactly. Convertibles are nothing but those securities that can be converted into equity. Then your depository receipts, and then your money market instruments like certificate of deposit. So these are the types of securities that can be loaned by the lender. So write this down before we discuss. The types of securities that are loaned can fall under two categories, something called as specials and something called as general securities. Is it clear now, Prabhakar? Is it breaking for everyone, or sorry, I think the mic was a little away, that's why I'll hold it closer. Okay. So, as mentioned, the securities that are loaned can fall under two categories, something called as general securities and something called as specials. So, general securities are those securities that are very liquid and widely available. What does very liquid mean?
Can be easily converted into cash.
Exactly. And they are very widely available in the market, meaning there are a lot of shares or bonds of that particular type that is available in the market to loan out. So that falls under general securities. So if it's general securities, usually the lenders would charge a lower rental fee, and borrowers have the flexibility to post what type of collateral they want to give to the lender. Is this clear? Yes or no?
Yes, ma'am.
Okay. And then you have something called as specials, which are those rare securities which are hard to borrow. In that case, if a lender loans out specials, then he can charge a premium on the rental fee, meaning a higher rental fee. Okay. In this case, now the borrower will have to be flexible in terms of what the lender demands as collateral. If the lender demands cash or non-cash, if it is cash, how much the lender wants. But there is also a certain benchmark of how much he can charge. Okay. But if it is non-cash, what type of securities he wants as collateral. Is that clear? Yes or no? Okay. Quickly write that down, and then we'll go on to collateral. So we know there are two types, which is cash and non-cash, and we'll discuss how fees are calculated and how the collateral is calculated, and the fees as well. Okay, the rental fees. Done, guys? Okay, so the next thing we're going to discuss is collateral. Okay. So, to protect the lenders, the borrower must post collateral or provide collateral. Lenders generally demand collateral that is highly liquid, has low credit risk, and has low market risk. Why is that?
So that in case of
Because
a default, it can be immediately converted to cash by the lender or
Exactly.
the security.
Thanks, Anupam. Correct. In case if the borrower defaults, then the lender can easily, in case if it, obviously if it is cash, you can't sell cash again, right? But if it is a non-cash collateral, it should be easily be liquidated and has low credit risk and has low market risk. Okay, so collateral can be cash or non-cash, and always the lender will require a collateral which is higher than the value of the securities that is loaned. For example, if the lender is loaning securities that is worth $1 million, then he would require collateral that is worth maybe $1.2 million. Okay, and that bit which it is over collateralized is called haircut, or it's called as lender's margin. You must have heard of this term haircut, right? Yeah, where did you hear it?
Government securities, repo agreements.
Exactly, in repo agreements. Okay, now here's another thing. The benchmark lender's margin, usually followed predominantly in SBL market, is if you're providing collateral in the same currency. So, for example, if you borrowed securities that is in dollars, or it's denominated, the value is in dollars, then usually the haircut of the lender's margin is 2%. Okay, we denote it as 102, but what it means is 2%. So I've given an example. So let's say the value of the securities loaned is 10 million, and if the borrower is giving, let's say, currency or even non-cash collateral, the value of that collateral has to be 10.2 million. Okay, if let's say the securities that are borrowed is denominated in dollars, but the borrower is giving them collateral in, let's say, either it might be euro bonds or euro cash, then usually the lender's margin is 5%. So if it is securities that is loaned is 10 million, let's say, sorry, 10 million euros, or sorry, let me reiterate that. If the securities loaned is $10 million, but the borrower is giving, let's say, euro cash, then he has to pay him 10.5 million euros. Is that clear? Yes or no? Yeah. So write this down before we get into the remaining part of it. Done, guys? Okay. So, as I mentioned, usually predominantly they'll either charge 102% if it's in the same currency, or 5% if it's in another currency, but also it can depend on the lender. Okay, how much margin he wants, lender's margin he wants on the collateral, on top of the collateral. So, what factors that he would take into account is the collateral's quality in terms of whether it is highly liquid or low liquidity, counterparty risk in terms of whether the credit rating is good of the counterparty, right? And also whether he is loaning the securities on open or on term basis. Okay. Additionally, the margin level is valued on a daily basis that to ensure the loan is sufficiently collateralized. What does this mean?
As on a daily basis, the value of securities keeps on changing. So that margin needs to be maintained.
Okay. This is sort of similar to a concept that you've learned in some other class, which is it?
Futures,
Yes, where you do something called as?
mark to market basis,
Brilliant. Thank you.
initial margin.
Yeah.
Initial margin and minimum margin.
Yeah. So let me explain this with an example. So let's say borrowed certain amount of securities, okay, which was worth, to keep it simple, let's say it was 1 million. Okay, it was worth 1 million. Now the lender, let's say, wanted collateral, he charges 2% margin. Okay, so collateral value was, let's say, 1,20,000 or 200,000, sorry. Okay, so let's say the borrower gave securities as collateral. Okay, the security that he's planning to give, let's say it's a share, the current market price, or rather the spot price, is, let's say, $12 per share. Okay,
Whatever typing, whatever you are typing is not reflecting on the screen.
is it? Others are also not able to see?
No, it's
No,
on the
you were
chat box.
typing on the chat box, na?
Chat box, yeah.
Yeah, it's
Okay.
okay.
Sorry, I should have mentioned that I'm typing it in chat. Sorry. Okay. So where were we? So the total collateral value the borrower has to post is $1.2 million. I mean, 1.2 million dollars. Okay. And let's say he's planning to give shares as collateral, and the current spot price of each share in the market is, let's say, $12 now. Okay, so in terms of number of shares he has to give as collateral will be how much? If it is $12 per share and the total collateral value is 1.2 million, how much will he have to give in terms of this thing? 100K, exactly. He has to give 100,000 shares, not dollars, Preeti, 100,000 shares as collateral. Clear till here? Okay. Now, in case if tomorrow the share price becomes, let's say, $10 per share. Okay. The collateral value was 1,200,000, right? So now number of shares that the borrower would have to give is 120, correct? But he already has given 100,000. Yes? Yes or no? Yeah. So he'll have to give additional 20k shares. Is this clear to everyone by what this sentence means? Margin level is valued on a daily basis to ensure the loan is sufficiently collateralized. Yes, it's sort of like a margin call, but in stock borrow lending, not in futures. So the collateral depends on the share market price? No, Surgeon. It depends on what collateral that the borrower has posted. Right? If it is usually a non-cash collateral, the value of that non-cash collateral can decrease in the market. If it decrease, then he'll have to ensure that the lender is sufficiently collateralized. Is that clear?
Hello.
So, ma'am, it is indirectly saying that, like I give a collateral to a particular person, and based on its value, obviously either he has to give more, or it has to map with the amount that he has lent, right? In other words,
Let me put it this way, Saujanya. It's not that I'm giving collateral to any person. I'm giving collateral to a lender from whom I have borrowed securities from. Right?
okay.
Now,
Yes.
the collateral that I've given him is non-cash collateral that has a certain value. Right?
Yes.
Now,
Yes.
always the collateral has to be more than the value of the securities that I've borrowed.
Right.
Right? Now, yesterday, when I gave you the collateral, I gave you 100,000 worth of shares because the price of that collateral per share in the market was $12.
Okay.
But now tomorrow, the share price of that collateral that I've given, or the collateral which I've given in terms of shares, those shares prices fallen down in the market. Now,
Right.
the lender who's holding that collateral, his collateral value also has gone down.
Yes.
So he has to be sufficiently covered.
Yes. Yes.
So that's why the borrower would have to post additional 20k shares to the lender.
Right. Right. Basically, that collateral should map to the security. In other words, even if it goes up or down, it has to map to that.
Value of the securities.
Okay. Okay.
Okay. Preeti, it can happen on a daily basis depending on how the lender wants it.
Hello.
Okay. Yes, Nikhil.
So the collateral is example is bond. They have collateralized the bonds. So bonds value also fluctuate on a daily basis. No?
So that way even they would have to calculate then.
Okay.
Okay. Is everyone clear with this? Yes or no? Yeah. So write this down, this bit, and we'll continue.
Ma'am, just one small question. If the value of the collateral goes down, what happens then?
That's the thing. No, if the value of the collateral goes down, then the borrower have to post additional collateral to ensure that the loan that or the securities that is borrowed is sufficiently collateralized. That's what we were discussing here, no, Anupam? I think your question was, what if the value of the collateral goes up?
Sorry. Yeah, goes up. Sorry.
If the value of the collateral goes up, then the lender would have to give that additional collateral back to the borrower. But in practice,
Okay. Okay.
I've worked in stock borrow lending. So in practice, what happens is they generally don't tend to return that extra collateral, the
Okay.
lenders. Okay.
So, are they legally not required to, or
You're legally not required to, because the thing is, first of all, the collateral is there to protect the lender, right? In case if the borrower
okay, yeah,
defaults. So if the collateral value goes down, then the lender is at risk. So the borrower gives the additional collateral. If the collateral goes higher
okay,
in the market, then the lender is not at risk, in the sense that even if the borrower defaults, he's going to get more out of the collateral when he sells it in the market.
okay, got it.
Okay,
Thank you.
no problem.
Also, another thing, is there a committee that's regulating this? This is happening over the counter, right?
Yes, but it is regulated by this securities regulator in the market. So in US it will be your
Okay,
SEC, in UK it will be your FCA,
okay, got it.
and
Thank you.
yes, it is an OTC market. It is not an exchange market. Done? Okay. So we'll calculate now, or we'll talk about collateral posted by borrower and examples of how it is calculated. Okay. So typically, lenders decide on what type of collateral to accept. So what this means is, if a lender is loaning out securities, he can ask the borrower either to give him cash as collateral, or he can even ask him, instead of cash, to give me non-cash collateral. So it's up to the lender to decide what he wants as collateral. Okay. So let's say if the lender wants cash collateral, and this is predominantly in the stock borrow lending market in the US market. In the US market, predominantly lenders ask for cash as collateral when they loan out securities. Okay, because it is then reinvested in the money market in the US market, and they get a reinvestment rate from which a certain bit is rebated back to the borrower. Okay. Usually, currencies such as USD, Euro, and GBP are considered as collateral in the stock borrow lending side. Is this clear till here? Okay. So we took an example. Okay. So let's say trade date of the stock borrow lending contract is 9th June. The term is, it's an open contract, meaning the settlement date is 16 June. So any time between 9 to 16, the lender can recall the securities. Okay. The securities that is going to be loaned, I just made this up, it's called Mario Corp. Okay. The spot price of each of these securities that is going to be loaned is $3.5. So the quantity that the borrower wants to borrow or the lender is going to loan is 500,000 shares. So the value of the securities is simple, 3.5 into 500,000, which is about $1.750 million. Is this clear till here? Yeah. So now the lender is demanding a margin of 4%. What is that 4%? It is on the collateral. So how is that calculated? We know that this is the value of the securities that is going to be loaned, right? So 4% of 1.5, you calculate that. Then you add that amount to 1.5 and you get $1.82 million will be the value of the collateral that is given in terms of cash. Is this clear to everyone? Yes. So the lender has said the reinvestment rate will be 120 basis points. The rebate interest will be 40 basis points. So in this case, what will be the rental fee that is charged now?
60 basis points. 80 basis points.
Exactly. It will be 80 basis points. It is 80 basis points on what? On value of collateral or value of securities? Correct. On value of securities. Is everyone clear with this? Yeah. So you want to write this bit down? This is it will be available in your recording. If you want to write it down, let me know before we have a quick classwork to calculate one collateral value and investment or rental fees. Yes or no? Do you want to write this down or can I continue? Okay. So small classwork. Do this calculation. So calculate the value of the securities, then calculate the value of the collateral, and then tell me what is the rental fee that is charged here. Done? What's the answer? So what's the value of the securities?
2 million.
Okay. What's the value of the collateral?
205 and then 4 zeros.
So,
So 2,050,000.
correct, 2,050,000. And then you keep missing some zeros in your answer. Okay. What's the rental fee?
Rental fee would be rental rate is 60 BPS and rental fee would be 2 million, 12,000.
Yeah. Okay. Not 2 million.
Sorry, 12,000.
Less.
12,000.
12,000. Yeah. Okay. So the rental fee that will be
Yeah,
charged here
12,000.
is 60 basis points, which is your reinvestment rate minus the rebate interest. Okay. The reinvestment rate is the expected return on which the cash will be invested in the market. Out of that, they have to rebate back 50 basis points to the borrower. So they just deduct that from the reinvestment rate, and what will be the remaining is the rental fee. Is this clear to everyone? Okay. So we'll continue. What if it is non-cash collateral? Okay. And remember, if it is cash or non-cash, rental fee is charged on both. The difference is if it is cash collateral, a certain interest is rebated back to the borrower. If it is non-cash collateral, then just a rental fee is charged. Is that clear to everyone? Okay. So now mostly non-cash collateral is used in the European markets. Okay, and generally government bonds are used as collaterals, like your gilts, bonds, OATs, BTNs, and treasury bonds. Okay, so again we'll take an example. So trade date 9/2. This time again the contract is open. Settlement is 16th. Again, let's say Mario Corp. Okay. The spot price of each share is 4 euros. The quantity of shares that is going to be borrowed is 1 million. So the value of securities will be 4 into 1 million, which is 4 million euros. The margin that the lender is charging is 2%. So 2% of 4 million, then add it up onto 4 million. The total value of the collateral is 4,080,000. Okay. Rental fee that the lender is charging is 75 basis points. Now, the collateral the borrower offers is UK gilts or UK government bonds. In the market, each value of the gilt is 100 euros. So how many gilts will you have to give in terms of collateral is nothing but this collateral value divided by 100. So the borrower has to post 40,800 gilts to the lender. Is this clear? Yeah. So again, quick classwork for you guys. Trade date 10th June, settlement 15th. It's a fixed contract this time. Securities.
Okay, here I want to ask, what is the use of rental fee in this whole? Are we using it?
Rental fee is what the lender gets in order to loan the securities. Preeti, why would I loan securities to you for free?
Oh, no, I'm asking, are we using this in calculation? Because I think it is not used here.
That is, here it is to show you what you're getting in terms of a lender. I just didn't calculate here and show you the number. Otherwise, this is what the lender gets at the end of the contract.
Okay.
Okay. It is sort of like you could say your trade economics of your SBL contract. You learned about trade economics, right?
Yeah.
Yeah. So this is like a trade economics of your SBL contract. You need to know everything.
Okay, so this is a piece of information that we need to know in this contract.
It is an important piece of information.
Yeah. Okay.
Right. So guys, calculate this. So we said securities loaned is Barclays shares. Spot price is £4 each. The quantity of shares that is going to be loaned is 5 million. So calculate the value, calculate the collateral, right? Collateral offered is going to be German bonds or German bonds. The value of each bond is 250 GBP.
Securities are 20 million. Collateral is 20,600,000,
Mm-hmm.
and number of guilds are 82,400.
Correct. Manchu was quick. So is it clear, guys, now how the collateral is calculated in case if it is cash and non-cash? Yeah. So I'm going to continue. So obviously during this time we were discussing about securities loaned, collateral given. Collateral could be cash or non-cash. If it is non-cash, again, securities loaned. Once it is loaned, who has the ownership on the securities? And again, if collateral is non-cash, who has the ownership on the non-cash collateral, right? So that's where we get into this topic, which is your legal ownership of the securities. Okay. When securities are loaned, absolute ownership passes on to the borrower and vice versa in case if it is non-cash collateral. Do you need me to explain the sentence more or it's pretty clear, right? So what it means is when a lender loans out securities, all the ownership of the securities passes on to the borrower. And if a borrower gives non-cash collateral, then that collateral's ownership goes to the lender. Is this clear to everyone? Yeah. So that means now the securities that are borrowed by the borrower, if there is any dividends or coupons, then they are entitled to receive it. Okay. But again, as per regulations, the borrower might have to compensate the lender on that loss of income. Now, the question could be compensate the lender by how much? Again, that percentage would be dependent between the lender and the borrower, what agreement they come to. So, to put it in terms of an example, let's say a borrower borrowed 1 million worth of shares. Okay. So now he is the legal owner on those shares. Okay. Let's say those shares, the company or the issuer decides to give dividend, and for simplicity's sake, the issuer says, I'm giving $1 per share. That means now the borrower gets 1 million in dividends. Agreed? Yes or no? Right? So, okay, Saujanya, what I'm saying is, I'm the lender, you're the borrower. You borrowed 1 million shares from me. Now, who's the owner on those shares?
The borrower.
You, in fact, in this example, correct?
Yes.
Okay. Now, the issuer of the shares declared dividends. And for simplicity's sake, let's say the issuer says, I'm giving $1 per share. That means now you were holding 1 million shares. How much dividends are you going to get?
$1 per share. So 1 million, or how many ever shares I have, I get that much.
You get 1 million, correct? Now,
Yes.
as per regulations, because originally the shares were mine and I loaned it to you, that's where the legal ownership gets transferred to you. You will have to compensate me for that loss of 1 million because you're getting that 1 million, right?
Okay. Yes.
Here's the thing though. How much do you have to compensate me for? That is
1
dependent.
million.
Yeah, if you want to give me the 1 million, I will not refute it. I'll take it, no problem. But it can be between the lender and borrower to discuss how much the borrower would have to compensate the lender on that loss.
But
Okay.
how is that a loss? Because see,
Because
$1 per share.
no, listen. I had the securities. If I didn't loan it to you, I'll get that 1 million, correct?
Yes.
Now,
Yes.
because I loaned the securities to you and you are the legal owner now, what's going to happen? You're going to get the dividends.
Yes. Yes.
And then at the end of the contract, you're going to return the securities back to me. But are you going to return that 1 million dividends that you got?
No, no, no. But I'm giving the lender's fee, right? So how
Lender's
is
fee
that a
is
loss?
separate, Saujanya. Lender's fee is I've loaned you something, I'm charging you fee for it because I won't do it for free. I want something out of it. But what I've given
Okay.
you, on top of that, you're earning an additional income of dividends, which was supposed to be mine because I'm not getting it
Okay.
now because I loaned the securities to you. Got it?
Okay. 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 Yes.
Okay. Lender surrenders the voting rights and the corporate actions as well. Now, here's the thing. Lenders can, however, recall their securities to exercise their voting rights or corporate actions. So, if we backtrack to the same example of me and Saujanya, where now I loan the securities to her, and bear in mind, this is an open contract, it's not a fixed contract. Okay, an open contract gives me the right as a lender to recall the securities anytime before the settlement date. Agreed? Yeah. So now what I can do is, I know the issuer is going to give dividends because I know he's going to make an announcement. He's going to tell when is the X dividend date, which we discussed about yesterday, correct? What is going to be the payment date, what is going to be the record date, etc. Right? What I can do is I can recall the securities back from Saujanya before the X dividend date. So what would then happen is, on payment date, I would get my dividends. Yes or no? Okay. So when it comes to ownership of the securities, absolute ownership passes on to borrower when he borrows the securities, and absolute ownership passes on to lender if he's received non-cash collateral. In case if the borrower receives additional income on the loans or on the securities that is borrowed, such as dividends and coupon payments, he has to compensate the lender for that loss. And on the other hand, if a lender thinks that the securities he's loaned, that the issuer might give coupons or dividends on it, if he's entered into an open contract, he can recall the securities in time for him to exercise his voting rights or respond to the corporate action. Is that clear?
Ma'am, if he has entered into the term contract,
Then he cannot.
okay.
Okay, then he cannot. Now, guys, do you think stock borrow lending, what do you think is the what do you say, time span of the contract? Do you think it's a long contract or a short contract?
Ma'am, short one.
Anand's put a question mark. It's a short contract, exactly. It's the, from my experience in working in stock borrow lending, the maximum I've seen as a value date on a stock borrow lending contract is 15 days. Maximum. Right? So it's a very short, it's a short term contract. It doesn't, I haven't seen anything more than 30 days. All right? Is that clear to everyone? So write this down. Legal ownership of the securities. And then, since someone raised the question at the beginning of the class that I think it was Sojani, I'm not sure, I forgot what the year. What's the difference between a stock borrow lending and a repo agreement? We'll get to that. Okay.
Ma'am, just a general question. Who actually framed all these processes and everything? Like, swaps, all that. When I see the processes, like, who had the brains to, like, all these small, small things are like, wow, the process was highly thought out.
So initially, when any product or this thing came into the market, they would have their ups and downs, right? So as the products started trading more in the market, that's when regulations came into picture more and more, and then all of this started. Like if you take the good old days of, let's say, maybe in the 1930s or 1920s, when trading was happening, it was just buying, selling. Okay, you bought, let me give you the shares, you give me the money, but there was no underlying rule as to, okay, if you default, what will happen, if you this thing, no. So as obviously the economies grow, regulators came into picture, and then frameworks started coming into place as well.
Yes, yes.
Done writing, guys? Can I continue? Okay, so difference between a stock borrow lending and a repo agreement. Okay, so first off, the difference in the purpose of why stock borrow lending is done and why your repo is done. So stock borrow lending is primarily done, sorry, there's a spelling mistake done, for market making, arbitrage, short selling, and collateralizing other transactions. What is market making? What's market making, guys?
Earning money by buying and selling of shares.
Yeah, it's usually market makers who provide a two-way
Market makers
quotation
are
on
employed
the.
by investment banks.
Sorry, Vatsal, your voice is very low. I can't hear you.
I'm saying market makers are employed by investment banks.
Because your investment banks are market makers, right? Because they provide two-way quotations on your underlies that they are buying and selling. Okay. What is arbitrage?
It is the taking of position in order to gain profit with a chance of getting losses.
It's trading in two different markets and taking positions in order to gain profits, but two different markets are involved.
First of all, Piyush, your answer was wrong. Anupam, your answer
Like
was
buying in
close.
one,
Nikhil, yes, what?
buying in one and selling in other, like
You're
the
saying
in
something.
cash market derivative.
Got it right. Buying
That's
low
the
in one market and selling high in the other market. Guys, arbitrage always works on a very, very simple concept. It is buying low in one market and selling high in the other market. Is that clear?
speculation is means the taking the position in the market in order to earn profit.
Speculation is always going to be, I am looking at something, I'm speculating the price will go up, so I'm taking a position in the market in order to make a profit. Now, if the market works in my favor, I will make a profit. If the market doesn't work in my favor, I'll make a loss. Is that clear?
Then its definition should be that in order to earn profit, but there is a chance of getting losses also.
I wouldn't add that sentence, because if you add that sentence in the interview, it will take you for a trip.
Okay.
Okay. No one would invest in the market if they're anticipating a loss in the market, right?
Yes, ma'am.
Okay, unless this thing is to sell high and then buy low. Got it?
Yes, ma'am.
Okay. Right. Short selling is the concept of selling or getting into a deal to sell something which you don't have with the intention that you'll get it in time for the settlement. Okay. Collateralizing other transactions is nothing but covering other this thing. This is predominantly used because when you did your settlements class, was a concept of central counterparties discussed?
Yes, ma'am.
Yeah. So in central counterparties, you would need to collateralize your deals. So that's why stock borrow lending is primarily done for market making, arbitrage, short selling, and collateralizing other transactions. Whereas your repo agreement is done because there's a short term deficit of cash and the borrower requires cash. Okay? Is that clear? Yes or no? Yeah. Now, types of securities that are loaned: shares, bonds, hybrid securities, your ABS, MBS. In a repo, it's primarily borrower sells fixed income securities for which he gets cash. That is a repo. A reverse repo is a lender buys the securities for which he gives cash. Right? Is that clear? Okay. The term of this thing. So your SBL is mostly open, whereas your repo is always fixed. It's a fixed contract. Okay. In your SBL, you have rental fee. Plus, if it's cash collateral, you have to pay a rebate interest back to the borrower if you're a lender. In a repo agreement, the lender only receives something called as a repo interest. Okay. Collateral. First of all, in a stock borrow lending, collateral can be cash or non-cash, and it is always over collateralized. Whereas in a repo agreement, the collateral is cash or non-cash?
Cash.
Non-cash,
A
exactly.
mix.
It's
It
always
is usually
usually
both, ma'am. Cash and
in repo.
Cash is also used, right?
In repo,
I mean, it's like a haircut it is used.
yeah, ma'am.
It's
guys,
haircut,
what
no?
is the definition of a repo?
Ma'am, it is the transfer of the government in lieu of government securities. You are providing some kind of cash.
So borrower has given securities because he wants cash, correct?
But the haircut margin need to be maintained in the form of cash, na?
No, you're giving collateral which is a non-cash. If you're borrowing cash worth 1 million and the haircut is 2%, that means you have to give them government bonds that are worth 1.2 million.
Okay.
In a repo,
Haircut is additional, I think.
we discussed that, Nikhil. Haircut is on your collateral. The question here, my question was, in a repo agreement, the collateral will always be a non-cash because it is securities that the borrower is selling to the lender, which is the collateral. Is that clear? Is this clear to everyone? Yes or no? The reason why a repo is
Yes,
done
ma'am.
is the borrower needs cash. Okay, because there's a short term deficit of cash. Right? When it comes to the entitlements, borrower has to compensate the lender on any income loss, right? Whereas in a repo agreement, the borrower or the lender receives the coupons and the dividends. Okay? So you want to write this down or you will copy it down when you go through the video recording? Guys, do you want to write this down or do you want to take it down when you go through the video recording? We'll copy from video. Okay. So let's continue. Now we're going to discuss the participants in your stock borrow lending market. So the first obvious one that we're going to discuss is your securities lenders. Okay. Security lenders are usually your institutional investors who have large securities portfolios, like your mutual funds, hedge funds, pension funds, insurance companies, banks, sovereign wealth funds, central banks. Okay, so usually lenders are your, or lenders in the stock borrow lending market are your, these guys: hedge funds, mutual funds, pension funds, insurance companies, banks, and sovereign wealth funds, and central banks. Okay. Now,
What is sovereign wealth fund?
sovereign wealth funds is nothing but a government set up wealth fund. It sort of works like your pension funds and hedge funds, but it is the primary sponsor would be your government. Okay. So lenders, when they lend in the market, they would try to follow one of these strategies that is mentioned below. The first strategy is called as value lending, or it's called as intrinsic lending, where the lenders usually lend scarce securities or your specials, okay, for which they can charge a premium on rental fee. The returns are high, but the opportunity to lend might be low. Okay, so I'm going to repeat it. You have value lending or intrinsic lending, where usually the lenders would loan out scarce securities not widely available. He can charge a premium on the rental fee. Returns would be high for the lender in terms of rental fee, but the opportunity to lend might be low. Okay. Then you have something called as volume lending or general securities lending. So general securities lending, it's as the word says, you're loaning out general securities. And volume lending means regardless of the scarcity, you loan out large volumes of securities. In this case, the rental fee might be lower, but there are more opportunities to lend. And this is one of the predominant strategies that is followed in stock borrow lending. Is this clear, guys? Yes or no? So write this down, or again, do you want me to continue and you'll copy from video, or you want some time to write this down? So under participants in SBL, the first participants is lenders. We discussed. Okay, cool. Next, we'll talk about, for lenders, what is this thing reasoning behind why they lend. So they get something called as lending revenue, right? So under that, the first thing is they get something called as fee income. So obviously lenders earn something called as rental fee. Okay. He can charge a high rental fee if he guarantees not to recall the securities. Okay. He can charge high lending fees if he's exclusive in lending, meaning he doesn't have many borrowers, he's only loaning to certain number of borrowers. Okay. He can charge a higher rental fee if they are flexible on receiving any type of collateral. Is this clear? Yeah. Next, reasoning behind why a lender lends is he gets something called as collateral reinvestment income in case of cash collateral. So in case if the lender gives cash, he would again reinvest it in the market and he would get returns on it, right? And another reason is it's a cheaper way of sourcing cash or raising cash. So let's say lender needs money for some reason and he has securities with it, right? He can loan it out to someone for which he can ask cash as collateral, right? Yes or no? Now he can reinvest that cash or use that cash for what he needed. And then when the
So you're saying the collateral that is given to him, he can reinvest that collateral to another third party, right?
yes, so for let me put it in this way. Let's say I'm a lender. Okay, I want to borrow $1 million, and I can either go to the bank and borrow 1 million, but let's face it, banks are greedy buggers. He would charge me a high interest rate. Correct? Other way I can do it is I could issue shares, but then to issue shares, it's a big procedure and all of that. I have to give away ownership, etc. Blah blah blah, all of that stuff. Even if I want to issue bonds, then I become a debtor. I have to give my creditors coupons, blah blah blah. Right? I want the money for a short term amount of time. I have securities with me. So what I can do is I can loan it out to a borrower. In return, the borrower gives me cash collateral. Now I take that cash, I use it for whatever I need. Now at the end of the contract, I return that cash. And the plus side here is, do I have to pay interest on it? Do I have to pay interest on it?
No.
I have to pay interest in terms of rebate interest, but then again, that won't be high as compared to the rental fee that I will be charging, correct? Yes or no? So I've loaned the
Yes, ma'am.
securities for which I'm charging rental fee, correct? Now I got in cash, I have to rebate some interest back to that fellow. But in essence, what am I doing is I'm going to use that money to whatever, maybe I had a loan that I had to pay back. So I paid back that loan. But now when I'm when I'm giving back the cash, I charge a rental fee, correct? That will be higher than the rebate interest. Yes or no? Okay. So it's a cheaper way of sourcing cash for lenders. All right. Can I continue or you want to write this down? Okay. Preeti is being very quick. Are you taking screenshots by any chance? No, Preeti? Okay. So the next thing we're going to discuss, or the next participants, okay, Preeti. The next participants that we're going to talk about is something called as securities lending agents. Okay. So all this time we talked about lenders, we talked about borrowers, right? What are the chances that lenders know who all are the borrowers in the market? It's not like a lender can stand on the road and say, hey, I have 100 shares or 100 million shares of Apple, who wants to borrow? Correct? Yes or no? Yeah. So you have someone to help him out there. It's called as securities lending agent. Now, however, lenders may not always use sec lending agents because they might have their own borrowers who borrow from them regularly. So, when lenders directly lend to the borrowers, this is called as principal to principal lending, okay, or direct lending. All right. Lenders would then retain all associated revenue, but the downside for the lender is he would have to invest in resources and infrastructure to support the lending program from the front office and the back office perspective. Okay, so what this means is if a lender is involved in principal to principal lending, where he directly lends to the borrowers without a middleman, he'll get all the revenue, but then the downside is he has to reinvest some of the resources in infrastructure and in creating a front office and a back office to do the proper flow of the stock borrow lending contract. Is this understood by people? Yes or no? Yeah. So the other side is, if the lender doesn't want the headache of setting up an infrastructure and all of that, he might use a securities lending agent, which is usually, or it is set up in two ways. You have custodians and you have something called as a tri-party specialist. Okay. And this middleman or the securities lending agent, which is your custodians or your tri-party agents or specialists, whatever revenue is now generated from lending the securities is split between the lender and the lending agent. Okay. So to put it in a diagram, so let's look at it this way. You have the lender who has the securities. He gives the securities to his lending agent, which can either be a custodian or a tri-party agent, and we'll differentiate between the both a little later. Now, on behalf of the lender, the lending agent will loan out the securities to the borrower. Okay. So let's say borrower gives cash as collateral. Now the lending agent will reinvest that cash in the market. And what returns come from that? A part of it, as I said, would be rebated back to the borrowers. The remaining would be split between the lender and the lending agent. Is this clear? Yeah. If it is non-cash collateral, then what would happen? This bit would not happen, but there's a rental fee that is charged, right? That rental fee will be split between the lenders and the lending agent. Ratio of the split would be dependent between the lender and the lending agent as to what agreement they come to. 50-50, 60-40, 65-35, whichever. Okay. Is this clear, guys? You want to write this down or shall I continue? Anupam is pretty quick here.
Can you scroll a bit down? I'll just take a quick screenshot.
No screenshot. You can copy from video. After all,
Okay.
screen. FYI,
Okay.
your PPT on LearnTron for stock borrow lending is pretty bad in my opinion, right? So this is notes that I've made from my experience working in the stock borrow lending side. So please don't share the notes to everyone, right? You can take a note of it from the video, all right? And this should be enough for your stock borrow lending class, because frankly, I think the PPT on LearnTron is bad. I saw it once and it was horrible. They need to change it. Right. Back to topic. Can I continue? Okay. Now, as promised, I said we'll discuss what are your tri-party agents, which is usually your custodians and someone called as tri-party agents. Okay. Now, if a lender uses a custodian as a sec lending agent in between or the middleman, and you all know what are custodians, right? Yes or no? Right? So, if a lender uses your custodian as a sec lending agent, what happens there is it helps the lender negate like admin costs and transaction costs and the functions of your like front office and back office, etc. Right? Additionally, if you use a custodian as a lending agent, custodians already have a lot of clients on their books, so they would have a large number of borrowers who would want to borrow. Okay, and they'll have a large pool, and the custodians will have a large pool of securities that they can lend. Yes or no? Yes or no, guys? Is this clear? Yeah. The downside, however, for using a custodian model in SBL and using a custodian as a sec lending agent is the custodian would pool all the loan securities or all the securities the lenders have, and then they form a queue system to allocate it to the borrower. So if I have to put this in an example, let's say if give me an example of a custodian.
Northern Trust.
Yeah. So let's say I was Northern Trust. Let's say Anupam has 1 million shares of Apple. Let's say Saujanya has 500,000 shares of Apple. Let's say Preeti has another 1 million shares of Apple. Okay, and you are the lenders, and you're using me as the custodian, as a sec lending agent. Now, altogether, I have 2.5 million Apple shares. Yes? Yes or no? 1 plus 1 plus 0.5, 2.5 million Apple shares, which I can loan on behalf of the lender. Now I have borrowers. So let's say Prabhakar wants to borrow 100,000 shares. Let's say Nikhil wants to borrow 1 million shares. Okay, that's a total of 1.5. I have a total of 2.5, but I only have to loan out 1.5, but I formed a queue system. So chances are either Preeti, Anupam, or Saujanya, one of your securities may not get loaned out to the borrowers. Yes or no? Yeah. So that could be a kind of like a loss of income for you there, because you cannot charge rental fee then. Yeah? So that's the downside of using the custodian model. Okay. Also, the collateral that is received is pooled and invested. The other side, you have tri-party or tri-party agents that specialize in securities lending. And here what they do now, instead of me being a custodian now, I'll be a tri-party agent. And one of the famous tri-party agents that are there, tri-party services provided by a certain bank is called as Chase. You've heard of Chase Bank, right? Yeah, they act as tri-party agents. So now, if I was a tri-party agent, whoever are my lenders, my client who are lenders, I do not pool their securities together. In fact, on behalf that of the lender, I would find borrowers and negotiate on behalf of the lenders in order to loan the securities out. Okay, and also the collateral that gets collected, I do not pool it. I would invest it on behalf of each individual lender. Is that clear? Okay. So, shall we take a quick 10-minute break also? I need to drink some water as well. It's almost 12:30. Come back at 40. Is that okay? Yeah. So after that, we don't have much actually. We just have role of securities lending agent. Then we have a bit about borrowers and why borrowers borrow. And then the last bit is the flow of a securities lending process. So maybe another 40 to 1 hour max left of this class. Okay. So I'll leave this open here. So come back at 12:40. Is everyone back? Okay, so let's continue. We are still under participants of stock borrow lending. We discussed about lenders. We discussed about sec lending agents. Okay, and now we're going to discuss a little bit more about the role of securities lending agent in the market. Okay, so what other services they give is one is access to market. One second. Access to market. So because your custodians and securities lenders have presence in the markets globally, like you take, I gave the example of Chase, right? Is Chase only present in one market or one market geographically or more? Does it have a domestic presence or a global presence?
Several continues.
Yeah, it has a global presence. So that means they have access to those local markets as well, right? So that means they can understand if there is a presence of large borrowers. So that will give their lenders an opportunity to lend. Okay, so as the sentence is, as they have a presence in the market, they can inform the lenders of the market demands and opportunities. Supply aggregation, because agents are typically having many lenders on the book, they can supply a lot of securities to the borrowers. Okay, risk management, they can implement risk management measures designed to the client specification. So what this means is it can depend on lenders this thing. Remember we said that the margin usually is followed as 2% and 5%, but if the lender wants more margin, that's what the agent can tell the borrower as well. Okay, collateral management. So now because you're lending securities, you're getting collateral either on a daily basis, right? So ensuring the client loans are secure, or the securities loans are secure and appropriately margined. Remember we discussed this a little earlier. When a borrower posts collateral, in case if the collateral value goes down, then they have to post additional collateral. So the lending agent on behalf of the lender would ask the borrower to post that additional collateral. Okay. Regulatory compliance, ensuring lenders are in compliance with the relevant regulatory obligation. What is one such regulatory obligation the lender has in terms of stock borrow lending? What is one
He has to reinvest the money. He has to
exact?
reinvest the money collateral that he gets from the borrower.
Yes, and rebate and interest back to the borrower. Okay. Income collection, collecting the rental fee, dividends, coupons, etc. Okay. And indemnification, which is providing protection for the lenders against certain risks such as default if the collateral is insufficient to cover the loss. Okay. One main point also to be noted is in case if the lender wants to recall the securities, then the lending agent has to ensure that the securities are recalled in time if the lender wants to sell or exercise his voting rights or corporate action. Okay, so these are the additional services a sec lending agent would provide to a lender. All right, is this clear? Okay, can I continue? Okay. So next bit, we're going to talk about borrowers. So all this time we were primarily focused on lenders, security lending agents, collateral, how collateral is posted, how it is calculated, etc. So now we're going to look at security borrowers. So security borrowers are typically your large banks and hedge funds. Borrowers are usually attracted to lenders that have a large portfolio of securities, especially the scarce ones. Also, they're attracted to lenders who don't recall securities quickly. And also, they're attracted to lenders who have a tax position that minimizes the cost of manufacturing the dividend or interest back to them. Do you need me to explain any of these points further, or it's pretty clear? Last one? Okay. So, if I have to put it in an example, let's say Akib, you're a borrower, I'm a lender, and let's say I'm a lender who's situated in a tax haven country. So, what does a tax haven country mean?
Taxes are very less.
Yes, taxes are very less. Now, the income that is earned, let's say you as a borrower, Akib, have borrowed shares from me and you have received dividends on it. Now, is this dividends taxable or non-taxable? Preeti says non-taxable. Wrong. Only government securities are non-taxable. Otherwise, any other securities by any other issuers are taxable. So, Akib, if you have to pay me for the loss of dividends, and since you receive dividends which is taxable, that's kind of a loss for you as well, right? However, if I'm situated in a tax haven country, for me to pay you back the dividends would be a little bit more easier. Is that clear now? Or it'll cost me less to pay you back the dividends. Okay? So, we have securities lenders who are these guys. If they directly lend to the borrowers who are these guys, it's called as direct lending or principal to principal lending. If they go through securities lending agents, they might either use a custodian or a tri-party agent. So we'll get on to the bit as to why borrowers borrow, right? So primary reason, market making. So banks and broker dealers are market makers that are required to make bid and ask quotations on securities, because they might not have enough of a certain security and they don't hold every security in the market. They might borrow to fill their buy orders of the client and to ensure the two-way quotation. Is this clear? Yeah. Second reason they might borrow is to prevent failed settlements. What is failed settlements? What is failed settlements?
Failed settlements are the settlements which, after the reconciliation is done, the book ledger doesn't match with the bank statements and they do not go through.
That is more in terms of cash. If you say failed settlements, it's basically if a trade doesn't settle. Simple, this thing is, let's say I made a deal with you, Anupam, that I'm going to sell to you 100 Facebook shares. And at the time of the settlement date, I failed to deliver those shares because I don't have them. So in order to avoid that fail from happening, I might borrow 100 Facebook shares. Does that make sense now as to what it means by to prevent failed settlements?
One again, market making.
Market making is nothing but, as a market maker, I have to give a two-way quotation. Now, if I have to give a two-way quotation for a buy, I can say, okay, how much I want to pay you if I'm going to buy. But if I'm going to sell and I have to do a quotation, I need to hold that underlying securities in order to make a sell quote. Is that clear?
Yes, ma'am.
Okay. Are we clear with failed settlements as well? Okay. The next is, as we discussed, collateralization of other transaction. Because of increasing regulations or regulators are pushing, especially in the OTC market, to use central counterparties. What would happen is counterparties or institutions might want to borrow securities in order to collateralize other deals. Okay. Fourth reason is something called as dividend arbitrage, where it's a trading strategy that involves purchasing put options. What is purchasing put options? Which type of option is it? Long put, short put, yeah, long call or short call?
Long put.
Correct. It's a long put. So what would happen is a person would enter into a long put option where he knows for sure that the company is going to give dividends, so he does it before the ex dividend date. So that means he'll be entitled to receive the dividend on the payment date. Okay, and then post the ex dividend date, he would exercise his put option, meaning he would sell the underlier at the strike price. Is this clear? Okay. So the last bit is your, you could call this as your life cycle of a SBL contract. Okay, like how you learned about trade life cycle, this is a life cycle of a SBL contract. So it starts off with execution, you have settlements, you have any material changes that happen, any corporate event or corporate action event that happens, termination of the contract, and throughout the contract, any redelivery, failed trades, or legal remedies that need to be done. So execution is pretty simple. It is nothing but entering into a stock borrow lending contract. And primarily now, especially because of the day and technology that is there, most of it is electronic, and you have pretty standardized and centralized automated functions for the front office and back office. In the execution stage, if you're entering sorry, my voice is going off for some reason. In the execution stage, when you're entering a stock borrow lending contract, what all other details will you have to note down? Like how you had your trade execution stage, right? In that you had details that you used to note down of a trade, right? So similarly, if it's a stock borrow lending contract, what are all the details you will be noting down?
Trade date,
Correct. What else?
settlement date,
Correct.
settlement date,
Mhm.
volume of shares,
Before that, also one more, whether it is an open or term contract.
open or closed,
Yeah.
term
Correct.
contract,
Yeah. Then what else? Number of securities that are going to be loaned.
stock,
Value
stock
of the
price,
securities. Correct. Margin.
price,
Collateral value. What is the type of collateral? What's the rental fee? In case if it is cash collateral, then what will be the rebate interest? Right? And obviously the counterparty. So these are all the details that will be noted. Is that clear? So Preeti, to answer your previous question, why we need all of those details when we were doing calculation of collateral value, now you know. Okay. The next stage is settlement. So settlement is done with the help of the lender's custodian bank. Lender requires a report of the securities that are loaned and the collateral that is received. In some markets, settlement is done FOP. What is FOP? What is FOP, folks? You must have learned this in your settlements class.
बिल्कुल.
Free of payment.
Correct. Free of payment. What does that mean though?
In that, the securities are settled first and the cash is settled by the end of the day.
Correct. So in this case, collateral is settled at the end of the day. Okay. So what would happen is throughout the day, let's say between Goldman Sachs and Morgan Stanley, there are a bunch of loans and borrows that are done. One way to do it is, let's say first GS loaned out securities worth, or rather to put it another way, they require collateral worth 1 million. And also they borrowed something for which collateral they're giving is 2 million. So instead of loaning, taking the collateral and then borrowing and giving collateral, what will happen towards the end of the day, they would just net it out between the two counterparties. Okay, is that clear? Yes or no? Is that understood, or you want me to explain it more? Okay, I can't.
Ma'am, could you repeat it once more?
Sure, let me put it this way. So you have GS, you have Morgan Stanley. So we'll look at it from GS's perspective, and what I'll do is for every loan he gives out, he gets a credit of cash or collateral. Agreed? For every borrow that he does, he has to pay collateral. With me so far?
Yeah.
Okay. So let's say the first deal that GS made with this thing, he loaned out securities for which he is going to receive, let's say, $2 million. Okay. And then he borrowed some securities for which he has to pay, let's say, $15 million. Did that right? No, 2 million. Okay. 1.5, let's say. Okay. Now, what they can do is first, okay, they loan, they might take the $2 million from Morgan Stanley and they give the security. Second, they borrowed. What they do is they borrow and they take or pay the 1.5 million to Morgan Stanley. But instead of doing it that way, because that will be multiple transactions, throughout the day they'll do loans and borrows. At the end of the day, they would net. So now in this case, because GS loaned out more securities and borrowed less, Morgan Stanley would have to pay the difference to Goldman Sachs before the end of the day.
Okay, got it.
Okay, so what has happened is the securities have settled free of payment. Is that clear? And the collateral is paid a little later. Okay. So material changes is the next bit. So if any substitution is done in the collateral, it should be agreed between the lender and the borrower, and any party wishing to recall or return the securities should have a regard of the implication to the counterparty and notify them ASAP. Now the first sentence, let's say I loaned out securities to, let's take some other person because I always pick the same people. Let's take Vatsal. Okay. So let's say I loaned out securities to Vatsal. He's paid me collateral in terms of securities. Let's say maybe UK gilts. Okay. Now, before the contract ends, Vatsal wants the UK gilts back, but in return, he'll substitute it with cash. Okay, that is what is meant by substitution in the collateral. but that can only happen if I agree to it. Is that clear? Yeah. Second sentence, what it means is I've loaned out the securities to Vatsal on an open contract. There is a there is a value date or a settlement date, but I want to recall the securities before the value date or the settlement date. So that could pose some risk to Vatsal, who is the borrower, right? Yes or no? Right? So I cannot suddenly one day wake up and tell Vatsal immediately, like, hey, I want to recall the securities. I have to give him at least a day or two of prior notification before I recall the securities before the value date. Is that point now understood? What it means by any party wishing to recall or return the security should have a regard of the implication to the counterparty and should notify them ASAP. Okay. Next is corporate action. So lenders might decide to take part in the corporate action event. If they want to do that and their intent is to call the securities back, again they need to notify the borrowers in time. Okay. Termination of the contract. How can a contract get terminated? If it's a fixed contract, it will get terminated on value date with the borrower returning the securities and the lender returning the collateral and charging the rental fee. Okay, is that clear? Now, sometimes what can happen is borrowers might decide to return the securities before the value date if it is an open contract, because maybe from somewhere else they can borrow those securities at a cheaper rental fee. Okay, but again, suddenly the borrower cannot wake up one day and say, hey, take your securities back because I found someone who can give me a better rental fee. They need to let the lenders know and maybe see if the lenders are willing to reduce the rental fee. Is that clear?
Ma'am, so the rental fees is given at the end of the contract.
No, it's given at the beginning of the contract, Anupam. In case if the borrower finds a better deal somewhere with another lender who's charging him lesser rental fee, he cannot just return the security immediately. He needs to let the present lender who is borrowed from that, I'm returning the securities. And if now the current lender is willing to reduce the rental fee, that is possible.
But the has already been paid by the borrower, right? Then what's the point in borrowing from somewhere else? He'll have to pay the rental fees again.
Fee is paid at the end. Rental fee is decided at the beginning.
Okay. That's okay. Got it.
Okay. And the final bit, redelivery, failed trades, and legal remedies. So, lenders need to ascertain the likelihood of the securities returned on time, and they should have the collateral that they have to pay back to the borrower, which they have taken. Okay. Any failure of redelivery in the loan securities or the received collateral, what will be the consequences is covered in the legal agreement. Like how you have your, when it comes to OTC market, which is the agreement that is drafted between two counterparties in OTC market. Yes, Divya. Thank you. What's the full form of ISDA? What's the full form of ISDA? I need to speak up louder.
International Swaps and Derivative Association.
Thanks, Anupam. Yeah, that's right. Okay. And the last bit, if the borrower fails to redeliver the loan securities, they may be required to compensate the lender for the cost of interest expenses or buy-ins. What are buy-ins?
Insurance.
Hmm?
Fail to deliver.
Piyush, I can't hear you unless you're saying something or talking to someone else.
Sorry, ma'am, I was just reading a sentence.
Okay. What a buy-in, guys? Again, this should have been covered in your settlements class. Is this covered? Yes, no, maybe. So Janya says no. So everyone, was this covered in your settlements class or not? Buy-ins.
No, ma'am.
Okay. So what are buy-ins is not buying back of shares. Buy-ins is technically, let me put it this way. Goldman made a deal with Morgan Stanley to sell, let's say, 100,000 Apple shares at a rate of $100 for settlement, let's say, today's what day? So let's say for settlement 11th or 12th of November. Okay. Now it's 12th of November. Ideally, GS would have delivered this 100,000 Apple shares and Morgan Stanley would have paid them 100 into 100,000. But on settlement date, this trade has failed because GS doesn't have 100,000 Apple shares to deliver. So as of 13th, this is called as a failed trade. Everyone with me so far? Okay. Let's say this trade is failing, and it is, let's say, 18th of November. Morgan Stanley trader is seeing this. Hey, I'm supposed to receive 100,000 Apple shares at $100 each from Goldman Sachs on the 12th, but they still didn't deliver. It's the 18th of November. I need these shares. What are they doing? Let me check with my back office. Morgan Stanley back office says we haven't received the shares. Now, Morgan Stanley front office, the trader tells, let's send them a buy-in notice. So the buy-in notice is always drafted by buyer, sent to seller. It will have the trade economics or the trade details of the entire deal. So the trade date, the settlement date, the direction, the quantity, the asset or the underlier. Okay, what is the price, what's the total value of the trade, etc. Okay, and it will also say trade is failing or trade has settlement date of 12th November. Today is 18th November. Trade is still failing. You have time till 20th November, provided this is a business day. I'm just randomly putting the date to deliver. If you fail to deliver, I will buy the shares in the market. And if I pay more than the agreed price, you will have to pay me the difference. Okay, so what it says is Okay, trade was supposed to settle on 12th. Today is the 18th. You still haven't delivered. You have time till 20th of November. As of 20th, if you still don't deliver the shares to me, I'll go buy the shares in the market. Now, if I pay more than $100 per share, the difference you will have to pay to me. That is a buy-in notice. Is everyone clear with this? Okay. So, as you can see, it's the seller who gets the notice from the buyer. So, if you look at this point, this loan securities, the lender might have made a deal on the back end to deliver the shares to someone else. And since the borrower has failed to deliver back the securities, the lender might have received a buy-in notice, right? And if he fails to deliver the shares in time or before the buy-in gets executed, he might have to compensate the buyer of the shares now for the difference if he has bought it in the market and paid higher for it. Is that clear? Okay. So that's what the last sentence means. With that, your stock borrow lending class winds up. Any questions?
So, ma'am, for the buy-in, it means that the lender fails to pay the amount, he fails to deliver the securities to the borrower. So the borrower sends a notice to the lender saying that, you have to give me in the stipulated time. If not, I will buy it outside the market, and anything that is above the agreed price, you have to pay the difference, right?
Wrong. Here's how it is, Saujanya. Listen. I'm a lender, okay? And you are the person who borrowed the Apple shares from me. Okay?
Okay.
Now, on the other side, I have, let's say, Vatsal again, who wants to buy the Apple shares. Now, the difference is, I've loaned the Apple shares to you, but Vatsal wants to buy the Apple shares from me. Okay?
Okay.
I made a deal to sell the Apple shares to him on a specific date. If we take this example,
okay,
let's say on 12th of November. Now, I've already loaned the security or Apple shares to you, and I've recalled it. I've recalled it, let's say, on the 11th of November because I want to deliver the Apple shares on 12th of November to Vatsal.
Okay.
With me so far?
Yes.
Okay. Now, here's the thing. You who have borrowed the Apple shares have not returned it to me yet. Okay?
Okay.
Because let's say the value date on the contract is maybe 18th or 20th of November. Again, this is a borrow, okay? It's not with Vatsal, it's with you. Okay. Value date on the borrowing contract, the stock borrow lending contract is, let's say, maybe 20th or 18th of November. Now, because I have to deliver Apple shares to Vatsal on 12th of November, I have put in a recall on 11th saying I want the shares back from you.
Okay.
Okay. But you have failed to give me those shares back. Now, on the other side, I failed to deliver to Vatsal. He waited for 2-3 days. He's saying 18th of November, I still didn't deliver. Now he sends me a buy-in notice. He says, hey, listen, you have till 20th. Give me those 100,000 Apple shares for a price of 100 that we've agreed. If you don't do this by the 20th, I will go buy Apple shares in the market. And in case if I have to spend more than $100 per share, then you have to pay me the difference. Is it clear now?
Okay, got it. Yes. Yep.
All right.
Thank you.
No problem. Any other questions, folks?
Okay, so the GS is under obligation because the GS has bought the Apple shares from Morgan Stanley.
No, no,
Is
no, no, no,
is
no,
that
no,
so?
no. GS is selling Apple shares to Morgan Stanley. Preeti, didn't you hear the whole
But on the
explanation?
first hand, it has bought.
No, first hand he had Apple shares which he's loaned to someone else. So in case of the example where I used me, Vatsal and Saujanya, Vatsal would be Morgan Stanley
Hmm.
now. And Saujanya would be maybe JP Morgan, who have loaned the securities to. Whereas Vatsal, who's Morgan Stanley, wants to buy the security from me.
Okay.
Okay? Which part, Akeem, you want me to repeat?
Ma'am, what is the
Sorry.
yeah? Hello, ma'am.
Tell me, Vinod.
Yeah, what is the obligation towards the borrower in this scenario? Because the
Obligation
spread
is
of buying in the I mean the difference
okay. Let me tell you that. So
that
let's say
borrower has to pay some rate to lender.
listen, na. So let's say we'll take the same example where Saujanya failed to deliver to me, which then entailed that I failed to deliver the Apple shares to Vatsal, which then entailed that Vatsal went into the market and bought the shares at $102 per share. Okay. So the difference of $2 into 100,000 shares, which is $200,000, Vatsal has sent me this thing, pay up. Because I paid more than 100, which was the agreed price, you have to pay me the difference, which is the $200,000. Now, this I will give to Saujanya. Why? Because Saujanya, I told you I wanted my Apple shares on the 11th, but you didn't give it back to me. Because of which I had to face a buy-in, and now I've been charged $200,000. Is that clear?
Okay, that difference will be levied to the borrower
Yes.
at the end of it, right?
Yeah. And
Okay.
it's not out of the blue that I will tell Saujanya, hey, I had a buy-in, it got executed, I'm charging you because I have to pay the pay the buyer the difference of the amount. I would let Saujanya know when I'm recalling the securities. The reason why I'm recalling is because I have a buy-in, and in case if you fail to deliver to me on time, and then which will make me fail to deliver on time, then if any charges are passed on to me or given to me, it will be passed on to you, and it will all be in writing, and it will all be stipulated in the SBL contract as well. Okay.
Got it. Thank you.
Any other questions? Okay, if you're saying something, I'm sorry, I can't hear you. For some reason, your audio is not clear. Can you type what you want to ask, Akib? Sorry, it's just sounding like static when you're speaking.
Ma'am, I have a question. It's not related to the topic though. Are like whatever topics and content that we covered in 2 days, are these enough? Or because on the LMS there are a lot of videos which aren't important.
Okay.
Like there are videos on Basil, which isn't important. So
So basically, how the
yeah.
program
So
is,
for the interviews and all, how should we prepare?
it would be dependent on which profile you're going for. So let's say if you're going for AML KYC, then you would read AML KYC PPT, you would read about Basil, you would read about this thing. It's basically it's additional reading. Now, in simple this thing, what basics are covered in class should be enough to get you through the interview.
Okay.
Okay, so it owing to the fact that when these guys are interviewing you, they know you're not from that relevant background, but you at least know some basics about the topic. they wouldn't devil into much details about asking. So they might ask you if they're doing, let's say, if you're interviewing for an AML KYC role, they would ask you what's AML, what is KYC, what is layers of money laundering, or other way they ask this question is, if I give you 1 crore, how will you launder this money? Then they would ask you about what do you know about Basel, because it's a regulation that is set pertaining primarily for AML KYC. So it depends. So from interview perspective, your basics that are done in class is more than enough to carry you through the interview. Okay. What all
Okay,
extra
and
is
we'll be getting the job description.
most definitely. So most of this thing, they give a job description, like what is it, like if it's for trade settlements, they'll tell you what product, whether it's equities or derivative products. If it is, like I said, like an AML KYC, they'll tell what's the profile. So you can always ask your placement coordinator what's the profile. Okay.
Ma'am, a quick question, ma'am.
Uh-huh.
Regarding money laundering, I think we were asked to submit, like, techniques of money laundering, and you're saying now that it will be asked in the interview. But why would this topic, like, why would we want to think about techniques of laundering money? Like, that's illegal, right? So, am I right in asking that, like,
Because Saujanya, you will be the person who is supposed to identify how, if someone is doing money laundering. So if you don't know the techniques, how can you identify? You know that saying, if you have to catch a robber, you need to think like a robber.
Yes.
That's what is applied here.
Okay.
Okay.
Thank you.
No problem. Any other question, folks? So I'm not sure if this is my last class with you guys, because after this you would have just asset management and regulatory environment and risk management class.
This also does collateral management.
Collateral management is covered in your stock borrow lending. Collateral management basically is nothing but, we discussed it, right? What, when you give out securities as loans, what collateral you received, are they sufficient for covering your securities that are loaned? Also, additionally, if the value of the collateral falls down in the market, you collect additional collateral from the borrower. So this, if you're doing principal to principal lending, the lender is responsible for it. If you're doing the indirect lending through a tri-party agent, then the tri-party agent or the custodian would ensure that your collateral is managed properly. Okay, there's no like a big broad topic on it. All right.
Ma'am, ma'am, can you hear me?
Yes, I can.
Hello?
Tell me.
Ma'am, in LMS, they have given something called domain. Okay, interview domain. Okay. So in that, they have given some tricky questions, like how to handle the tricky questions. They have also given answers, and given some questions, and they have given the answers also. So will the interviewer will ask these kind of questions? Like it is really very much tricky, but like it is totally out of the box, out of the things which we are learning here. That's what.
So sometimes what happens? So these basically
Do we really need to study all that?
No, you don't need to, but it won't hurt to take a glance through it. The reason is because, if I'm not mistaken, all of these domain questions were asked in interviews for our candidates who went through us for interviews. So what Ematicus does is, whenever a candidate goes for an interview, they ask them what are the domain questions that are asked, and they keep a file on those questions, and they give it to the next students that go through the course for them to get an idea of what sort of questions can come. You don't have to mug it or anything, but it wouldn't hurt for you to go through some of those questions.
Okay, ma'am.
Nikhil, again, Basel understand the concept why Basel. So we have Basel 3, if I'm not mistaken, as of now. So I would focus more on Basel 3 instead of Basel 1 and Basel 2. Okay. Any other questions? Yes, no, maybe. Okay, then.
Ma'am, one last question. Sorry, I'm really sorry. One last question. In the month of December, I have training to attend for the weekends. So I just wanted to understand, like, a tentative date, when this course would, end, so that I can give those dates to my colleagues.
You can check with you're from Bangalore batch or you're from Delhi batch?
Yeah, it shows Delhi, but I'm actually in Hyderabad.
Okay, if you're Bangalore batch, then check with Kiran when your course is ending. For my calculations, with what is left over from your this thing, so next weekend, if they cover the 2 remaining classes, then the weekend after that should be your final mocks or this thing if you don't have any soft skill classes in between. So maybe my calculation again would be maybe by 6th of December you would finish, but then again check with Kiran, the governance.
Okay. Okay.
Okay.
Thank you so much. Thank you.
No
Yeah.
problem.
Bye.
Bye. So guys, if there is no other questions, I think we are done for today. So again, please revise and be on track on your domain, and hopefully you guys get placed soon. Okay. Right. Thanks, guys. Have a good weekend. Bye. Oh, by the way, yesterday's recording Kiran will upload because I was facing issues in recording. So he has the recording, he'll do it. And I also let him know about some previous recording was in audio, right? So I told him about that. So hopefully he'll upload the video recording. And today's class I have recorded, so it will take about a day for it to convert. Once it's get converted, I'll send the link to Kiran and he'll send it to you guys. Okay. All right. Okay, then. Thanks, guys. Have a good weekend. Bye.